What if 2025 is the year everything changes, not from what you see on the news, but from what banks are quietly doing behind closed doors? Look around. The data is screaming. Credit defaults climbing, corporate buybacks slowing, insiders cashing out at record levels. The numbers tell a story the media won't touch. Yet the market keeps pushing higher as if gravity no longer applies. It feels engineered, doesn't it? Like we're watching a game where only a few know the real rules. And those rules, the ones banks don't want you to understand, point to something they're calling the end game, a final phase before the reset. Once you see what they're positioning for, you'll understand why 2025 isn't just another year, it's the turning point. So stay until the end, hit that like button, and let me show you their playbook. Because the clock is already ticking and time is running out. There's a metric I've been tracking for decades, one that Wall Street prefers you ignore. It measures the total value of publicly traded corporations against the nation's actual economic output. Right now, that ratio sits at 216%. Let me put that in perspective for you. We're looking at roughly $66 trillion in market capitalization stacked against a $30 trillion economy. The stock market is worth more than twice what the entire country produces in a year. Anything beyond 100% signals overvaluation. We crossed that threshold long ago. Remember the dot-com implosion of 2000? That ratio peaked at 115% before equities collapsed by more than 60%. Today, we're not hovering near 115. We're not even at 150. We've blown past 200%. By every historical benchmark, we should be witnessing financial carnage right now, and yet the buying continues. Look at the S&P 500's dominant players. These market behemoths are trading at price-to-earnings multiples exceeding 60. Under normal conditions, a solid enterprise trades between 15 to 20 times earnings. Even aggressive growth stocks typically range from 25 to 30. But 60? That's economically absurd. You're essentially paying $60 for every single dollar of actual profit. Imagine purchasing a coffee for $60 when it's worth $1. Irrational, right? Yet investors keep lining up. So here's the central question. If valuations have reached insane levels, if history proves crashes follow these patterns, if sophisticated money is rotating into cash, why does this market defy gravity? The explanation isn't found in fundamentals. It's embedded in government intervention, perverse incentives, and systematic manipulation of capital flows. Here's what they won't tell you on CNBC. Markets don't float on earnings reports or innovation cycles. They float on liquidity, the sheer volume of money coursing through the financial system. And that liquidity, it's manufactured. Consider the federal budget mechanics. Washington collects approximately $5 trillion annually through taxation. Sounds substantial, doesn't it? But here's the kicker. They spend $7 trillion. That's a $2 trillion annual deficit, and it's not slowing down. Where does that extra $2 trillion originate? It doesn't materialize from productivity. It's extracted from future generations, conjured through debt issuance, and injected directly into the economic bloodstream today. Follow that money. It flows into household bank accounts, corporate balance sheets, and inevitably equity markets. When consumers suddenly have excess liquidity, consumption accelerates, travel bookings surge, retail spending climbs, investment accounts swell. Each transaction inflates corporate revenue figures, which in turn props up share prices. On the surface, it resembles economic health. Beneath, it's a Ponzi scheme running on borrowed time. Why does Washington persist with this dangerous game? Because since 1945, America's global supremacy hasn't rested solely on military might. It's been anchored in economic architecture. The dollar became the world's reserve currency. Wall Street became the planet's financial hub. Every nation needed access to our system for trade, capital, and technology, but that monopoly is fracturing. Beijing is constructing alternative payment rails. New Delhi is forging independent trade networks. Dozens of nations are negotiating in currencies other than dollars. They're rejecting American financial hegemony. This challenges the very foundation of U.S. power. So Washington's response? print more, borrow more, flood the system with trillions to maintain the illusion of stability. But every dollar created carries a hidden tax: devaluation. Let me explain the mechanism Wall Street hopes you'll never grasp. When central banks expand the money supply, each currency unit loses purchasing power. It's mathematical certainty. Picture an economy with $10 in circulation. Double that to $20. Those original $10 didn't gain value, they were diluted. That's monetary inflation in pure form, and it's accelerating now. The dollar is hemorrhaging purchasing power. But here's the twist: financial elites profit from this decay. As currency weakens, corporations adjust prices upward. Revenue climbs, earnings improve. Not because they're producing more, because the measuring stick is shrinking. Inflation creates the illusion of growth. When headlines celebrate record stock prices, ask, are businesses more productive, or is the dollar simply worth less? Consider this example. A company generates $100 in sales with $10 profit, a 10% margin. Inflation drives that product's price to $200. If margins hold, profits double to $20. To shareholders, this looks like expansion. In reality, nothing changed except currency debasement. This illusion has artificially extended the market cycle beyond its natural lifespan. We're not seeing genuine productivity gains. We're watching devaluation of the measurement system itself. It's not innovation driving these valuations. It's reckless fiscal spending and systematic destruction of dollar purchasing power. Now, here's where this becomes deeply troubling from a structural standpoint. This entire monetary architecture doesn't distribute benefits equally across society. It channels wealth upward with surgical precision. The wealthiest 10% of American households control the overwhelming majority of equity market holdings. The bottom 90%, they own mere fragments, if anything at all. So when inflation inflates asset prices while simultaneously eroding the purchasing power of earned income, you witness a devastating divergence. The affluent watch their investment portfolios appreciate in nominal terms. Working families watch their savings accounts evaporate in real terms. Basic essentials, food, shelter, energy, become prohibitively expensive. Wages either stagnate completely or crawl forward at rates far below actual inflation. The same mechanism propping up equity indexes is simultaneously crushing household budgets across the country. And the banking sector, they've engineered this dynamic perfectly. While ordinary people struggle under mounting living expenses, financial institutions harvest profits from every loan originated, every credit card balance carried, every mortgage payment collected. The debt cycle perpetuates the entire charade indefinitely. Before we go further, if this perspective is valuable to you, please hit that like button and subscribe to this channel. It genuinely helps more people access this critical information. Let's be absolutely clear about something. What's unfolding right now is not sustainable by any economic metric. This is a precarious structure held together by three fragile elements: collective belief, unprecedented debt levels, and the desperate hope that the music never stops playing. But economic history teaches us an unforgiving lesson. The music always stops. Every expansion eventually contracts. Every boom inevitably meets its bust. And the mathematical relationship is consistent. The larger the boom, the more devastating the collapse. The sophisticated money understands this pattern intimately. Consider Warren Buffett's positioning right now. He's accumulated more cash reserves than at any point in his investing career. He's not chasing momentum. He's not buying the rally. He's waiting with discipline. Why? Because he recognizes that when the correction arrives, and it will arrive, it will generate the most significant buying opportunity we've seen in decades. The question isn't whether the market will correct, the question is when. And when that correction begins, it won't be random market noise. It will be the inevitable consequence of the same artificial forces inflating prices today. But before anxiety sets in, understand this critical point. What unfolds next depends on dynamics the banking sector desperately wants hidden from public view. They're orchestrating mechanisms behind closed doors. While you track daily price movements, they're executing an entirely different strategy. In the next section, I'll expose precisely what they're engineering, how they're manufacturing this illusion, and why 2025 could mark the endgame they've been positioning for all along. Now that you understand the surface mechanics keeping markets elevated, let's examine what's really occurring behind institutional doors. This is the part banking executives and policymakers would prefer remained obscure, because once you grasp these dynamics, you'll recognize we're not experiencing healthy economic expansion. We're trapped inside a meticulously controlled illusion that extracts wealth from the many while enriching the few. The reality? Markets aren't rising on organic growth fundamentals. They're being manipulated by the identical forces that engineered every major financial crisis in modern history. The difference now? They've perfected the concealment. Every data point released, every statistic publicized, every soothing statement from Federal Reserve officials or Treasury secretaries, it's all theater. Carefully choreographed messaging designed to maintain your participation, suppress your alarm, and extend the system's lifespan just a bit longer. Because the moment collective belief fractures, this entire construct implodes. Consider recent Federal Reserve policy. They executed the most aggressive interest rate hiking cycle in 4 decades. The official narrative? Fighting inflation, protecting consumers, ensuring economic stability, that's the public story. But rate increases serve a far more critical function for the financial system. They protect banking sector profitability. Each rate hike makes borrowing more expensive across every category. Your mortgage costs more, your credit card interest climbs, your auto loan rate jumps. You absorb the pain, banks harvest the profit. It's wealth extraction disguised as monetary policy, and here's the darker mechanism. When rate pressure eventually breaks households and businesses, when defaults surge because debt service becomes impossible, who positions themselves to acquire distressed assets at massive discounts? The exact same financial institutions that profited from inflating the bubble initially. This is the cycle they've engineered with mathematical precision. During expansion phases, they distribute credit freely. They encourage speculation. They flood markets with liquidity. Then during contraction phases, they restrict lending, allow asset prices to crater, and systematically buy everything of value for pennies on the dollar. This isn't a financial system designed for growth. It's a wealth transfer mechanism. Capital flows from the working majority to the financial minority with clockwork regularity. Every boom-bust cycle consolidates more wealth at the top. And we've now entered the phase where internal contradictions are becoming impossible to ignore. Corporate debt has reached near record levels. Commercial real estate markets are displaying structural cracks. Household savings rates have collapsed to dangerously low thresholds. Credit card debt has exploded to unprecedented heights. These aren't indicators of economic strength. These are seismic warning signals preceding the main event. Yet here's the fascinating paradox. Equity markets exhibit complete indifference. Negative employment data emerges, stocks rally, major corporations announce mass layoffs, share prices surge, GDP growth disappoints, investors celebrate. Why this inverted response to deteriorating fundamentals? Because the entire financial architecture now rests on a single assumption that regardless of circumstances, the Federal Reserve will intervene to prevent collapse. That assumption functions as the system's life support. It's the animating force banks depend on, absolutely. Whenever anxiety begins permeating markets, carefully crafted statements from central bank officials restore calm. But understand this critical distinction. Rhetoric doesn't alter reality. It merely postpones the reckoning. What we're witnessing is the terminal phase of a bubble that has defied expectations for duration. Liquidity is systematically contracting. Fiscal policy has become mathematically unsustainable. Average households can barely service basic living expenses. Corporate profit margins are compressing, yet equity indexes continue their ascent because the illusion must persist. The moment collective belief evaporates, the entire mechanism ceases functioning And here's the truth. Financial institutions will never acknowledge publicly markets don't operate on analytical logic, they operate on psychological faith. As long as participants believe their capital remains secure in equities, the bubble maintains structural integrity. But when that faith dissolves, no policy intervention can prevent what follows. We may be closer to that inflection point than conventional analysis suggests, because every systemic collapse in financial history follows an identical progression, gradually, quietly, through minor fractures that mainstream participants dismiss as noise. The 2008 housing implosion didn't commence with panic. It began with isolated mortgage defaults, regional bank failures, seemingly contained problems. Then suddenly, catastrophically, the entire structure collapsed. The dot-com bubble didn't burst through immediate chaos. It deflated through incremental recognition that valuations had detached from any economic reality. We're observing those same warning patterns emerging now. But this cycle carries amplified stakes. The scale is global. The U.S. government has accumulated debt loads, expenditure commitments, and institutional promises so massive that even marginal confidence erosion could destabilize the entire framework. Consider the cascading scenarios. What occurs when Treasury borrowing faces genuine political resistance? What happens when foreign central banks reduce dollar reserve allocations because confidence in U.S. fiscal discipline has evaporated? What transpires when debt-saturated consumers finally exhaust their capacity to spend? This system requires perpetual motion. Capital must continuously circulate. Spending must persistently expand. Belief must remain unshaken. The instant any component stalls, the gears seize. And when mechanical failure occurs, collapse doesn't stem from a singular catalyst. It results from systemic exhaustion. The machine simply depletes its fuel supply. Here's the ironic element. Banking institutions understand these dynamics more intimately than anyone. They're actively positioning for the inevitable. While financial media perpetuates growth narratives, major banks are quietly reallocating into tangible assets, commodities, gold, real estate. They're systematically reducing equity exposure while retail investors continue pouring capital into index funds at valuation peaks. It's the identical playbook repeated through every cycle. Sustain the narrative for mass participants until the final moment. Then rotate positions immediately before systemic failure. When markets crater, they're positioned with capital reserves to acquire quality assets at Depression-era pricing, thus initiating the next extraction cycle. So, will we witness a market collapse before 2025 concludes? Perhaps not through overnight capitulation, but the structural conditions are systematically materializing. Liquidity is progressively tightening. Corporate profitability is decelerating. Dollar purchasing power continues eroding. Most critically, collective confidence is beginning to fracture. The moment this illusion can no longer maintain structural integrity, the instant a major catalyst emerges, whether geopolitical disruption, sudden credit seizure, or sovereign default, the unraveling commences. It typically unfolds in stages: initial modest correction, then more substantial decline. Finally, full systemic panic. The progression follows a predictable pattern. First comes disbelief that anything is genuinely wrong, then denial that it could worsen. Finally, fear-driven capitulation. But here's the dimension most participants overlook entirely. Every destructive cycle simultaneously generates opportunity. The identical system that annihilates wealth also concentrates it, depending entirely on your positioning when structural failure occurs. Those who prepare proactively, who comprehend the underlying mechanics, who maintain positions in tangible assets and exercise disciplined patience, they emerge from chaos strengthened. Those who dismiss warning signals get devastated. This isn't about predicting the precise timing. It's about recognizing the recurring pattern, because patterns don't lie. They've repeated with mathematical regularity for over a century, and they're repeating right now. Don't allow surface tranquility to deceive you. Beneath apparent calm, pressure is accumulating exponentially. Banking executives know this. Institutional portfolio managers know this. Connected insiders know this intimately. They simply hope you continue believing the narrative until they've repositioned their capital beyond risk exposure. That's precisely why they maintain public silence, why they counsel staying invested, thinking long term, trusting the system unconditionally. But the system they're asking you to trust is the identical system they manipulate with algorithmic precision daily. And when it fractures, they won't absorb the losses. The reality? We're positioned at the precipice of one of modern financial history's most precarious moments. Markets appear invincible, but they're suspended by threads of unsustainable debt, psychological faith, and policy interventions. All it requires is one unexpected shock, one catalyst that shatters the illusion of control. Whether that arrives before year end or during 2025 remains uncertain. But one element is absolute. This isn't if, it's exclusively when. And when systemic failure manifests, those who recognize the pattern won't experience surprise. They'll be prepared. While mass panic engulfs markets, they'll understand that chaos represents the inverse of opportunity, so examine the data critically. Question official narratives relentlessly, and never forget the calm preceding catastrophic events always feels secure, until suddenly it doesn't. Financial institutions don't want you perceiving these dynamics, but now you do. The choice becomes yours. Believe the manufactured illusion, or prepare for what emerges after it disintegrates? Subscribe to this channel for continuing analysis. Hit that like button if this perspective provided value. The decision is yours. But understand, so are the consequences. Share your analysis in the comments below. I want to hear your perspective on these dynamics. And remember, I'm not providing financial advice. This represents educational analysis exclusively. Your decisions and their outcomes rest entirely with you.